value trades, forex, CFDs, and commodities.
My name is Daniel Schütz, and I welcome you to this webinar of Value Trades that evening. And we have a nice topic. It's swing trading. We're going to talk about the next 60 minutes. And yeah, before we start with the webinar, I would make clear that you can all see my screen and that the audio is good for you. Yeah, okay, I see. Audio is good. You can see my screen, so we can start with the webinar. May I ask you if you have any question to get that question back to me at the end of the webinar, because I'm traveling at the moment and I only have a small screen and I can't look the whole time at the chat. So please ask your questions at the end of the webinar and I will be happy to get back to you then. Before we start with the webinar, I would love to give you the risk disclaimer. So please take a minute and read the risk disclaimer. And for those who don't know me, let me introduce myself very shortly. My name is Daniel Schütz. I'm a professional trader, a private investor, and day trader. Usually I live in Germany and I do trading for a living. Besides that, I'm editor-in-chief of the Portfolio Journal. That's a journal we give away for free. It's a German publication. Every month we have around 12,000 readers of that publication. Besides that, I write books, Trading for Beginners. That's the orange book you can see on the right side. That's already in its 5th edition and it's about trading for beginners. So that's really what I'm passionate for, to teach people how to get into the market and what to do, how to manage their trades and so on. I'm a certified financial technician and yes, I'm a trading coach. If you want to learn more, visit my website. You will find the link here. So we can start with the topic. The topic today, it's swing trading. And before we start with the swing trading, we have to make sure that we can understand what kind of market analysis is out there. What are my opportunities if I want to get into the markets, and how can I do my analysis with that? There's the fundamental analysis. That's usually using the economic and accounting information to predict the prices. For example, if you have a stock you want to analyze, then you are using all the economic data you can get and all the information to predict where the price can go. A little bit different of that is technical analysis. Technical analysis is using the price information to predict prices. So what happens in the past may be relevant for the future prediction of the prices. For example, the price patterns, you know about that. That's what technical analysis is about. But what exactly is swing trading? To explain what swing trading is, you need a little understanding of the markets. Since this is knowledge, or since this knowledge is elementary, we will deal very much with the Dow theory in this webinar, especially at the beginning of the webinar, because the markets move in so-called waves from one to the next or more waves. This is what we call a swing. And you try, in swing trading, you try to take one of those swings with you and to ride it until to the end. Since it usually takes time until those movements will show up, swing trading is by definition a type of trading that goes over somewhat longer period of time. This can be several days, weeks, or even months. This depends very much on the understanding, or not on the understanding, but depends on the underlying what is going to be traded. And the investment horizon in trading. We have the short term, the medium term, the long term, and others. Of course, smaller swings, for example, in short term trading, will also develop. This has something to do with the fractional structure of the markets. But by definition, swing trading is designed for medium-term period. So usually a 4-hour or daily chart is selected for swing trading. This, of course, depends on the market. Not every market is traded 24 hours a day. For markets such as stock markets that are only open for 8 hours or 8.5 hours, depends what market you're trading, I would rather choose a daily chart than a 4-hour chart. On the other hand, currencies, for example, that are traded almost around the clock, the 4-hour chart is very popular with that. These attitudes on the long time levels naturally make acting on the markets very relaxing or very relaxed, because the trading decision is always made on the basis of the closed candle. So we wait until the candle is closed before we make any trading decision. For 4-hour chart, therefore, it's necessary to check every 4 hour at earliest, not before that, because we wait until the candle is closed. And only once a day if you try to trade on a daily chart. So for this presentation, I use the time frame of a daily chart. Before we start by taking a closer look at the Dow theory, let's take a look at how a trend that we want to trade actually arises. We have different types of traders. And if you take a closer look to that market, you will see the market is moving sideways at that. You see it with the green lines, and at those green lines, we have 3 different types of traders. So we have traders, they are already long. We have traders who are already short, and we have the undecided traders. So the long and the short ones, these are the first who can wait until something is developing and they are already positioned in the market. The other ones, they are undecided. They wait what will come out of this side range when the market breaks out. And if this happens, when the market breaks out, all 3 groups of traders have an interest in the markets coming back from a point above. That's what you see here, for example. First, the traders who are already involved in a long position, maybe they take their profits and the markets start to fall. But we also have the traders who are already in a long position and see, okay, market was breaking out of that range, and maybe I'm on the right side of the market and I want to stock up my position. So they wait until the markets will come back so that they can increase their position size. We have the traders who are already short, and they hope the markets will come back so they can sell their position at a better price. And with the undecided traders, those who are waiting on that side movement, what will happen then? And they now see, okay, the direction of the market must be in the long, on the long side. And so they also wait for the markets coming back. And so I told you already, the first traders in the market, for example, the day traders, they already have the money on the hand and they want to close their positions. And so pressure is coming to the markets and the markets fall. Maybe the markets come back to a structure level. That's what you can see there. And if that happens, then some pressure is coming into the market. So we have the traders, they were already short and they want to increase their position, they buy. We have the short traders, they close their positions, and we have the undecided traders, they wait until they can also open a position in that market. So that's what happens on the market movements. That's the psychology behind that. And most strategies in swing trading are trend following strategies. In such cases, it's often impossible to reach the exact turning point of a market. Neither when getting in, okay, let me say that way. You never will reach the exactly point of getting out on the bottom or getting in at the bottom. So sorry, getting in at the bottom or getting out at the top. That's not what happens. So actually the goal of a swing trade is to cut a good piece out of the middle of a trade. That's what you see. That's what between the red lines. And I'd say if you get 2/3 of a swing, you're on the bright side. That's what we try to do. We don't try to get in at the bottom and to get out at the top. We try to cut out our piece of that movement. And so, yes, as I said, I'm happy if I can get 2/3 out of that movement. As I've already said, the basic understanding of the trends is essential for the understanding of the swing trading. And that is why we have to deal with it now. Trend theory is part of the technical financial market analysis, and technical analysis has 3 important basic assumptions that will only look in, or that we will look in now. We have the market discounts everything. That's the first assumption. Prices move in trends. That's the second, and history tends to repeat itself. What does that mean? Discount. The market movement discounts everything. The cornerstone of the technical analysis. That means prices reflect all news about supply and demand. The news situation influences supply and demand. For example, good news leads to rising demand, leads to rising prices, and the fundamentals get bullish. Bad news leads to rising supply, leads to falling prices, leads to fundamentals bearish. So all the news about supply and demand is reflecting the price movement. It is not in the chart, or is it not? Let's say that. Is it not in the chart that causes the market to fall or rise, but the bullish or bearish psychology of the market? That's what we're going to see. The reason for the price movements does not matter for the technical analyst. Only the result that he can see on the price movements in the chart. Trend. Prices moves in trend. That's absolute founding or basic for everything in technical analysis. A trend is identified as such to trade afterwards. And so the trend will be one of the big topics in that webinar. You all know the saying, the trend is your friend. And then as third, history repeats itself. The stock exchange and the financial markets and trading currencies and all that, that is psychology. The market, they are nothing more than people, and people act in similar situations quite comparable. Chart pictures repeat themselves again and again, and that is what we are using in technical analysis to predict market movements. The key to understanding the future lies in studying the past. That's some of the key assumptions of technical analysis. And it all started with Charles Henry Dow and Edward David Jones. They founded the Dow Jones Company. I think it was around 1880, 1882, something like that. And Dow published its first share index consisting of the closing prices of 11 shares, 9 railway companies, and I think it was 2 manufacturing companies. And that was the basic for the first index, the Dow Jones Index. And what Charles Dow also did was that he wrote articles in the Wall Street Journal. That's a journal of the Charles Dow and Edward David Jones Company. And he brought up his ideas about market movements in those articles. And this is the origins of the technical analysis in the Western world. And what he developed around the 1880s, it's still veiled today. The Dow theory uses in the original of the 1880s uses only closing prices, and the indices discount everything. So every information that's out on the markets, that's already priced in at the actual chart picture you see. The market has 3 trends: a primary trend, that's a long-term trend, a secondary trend, that's a medium trend, and a tertiary trend, that's a short-term trend. And you have to think back in the 1880s, things like a 5-minute chart or 15-minute chart, the hourly chart, it was not existing for private investors. So all the theory Dow did was on a closing price of the markets. So it was a daily chart, and that's what we're using in that webinar. Sorry. Let's take a look at the chart. And what you see here is a typical chart picture, and we will see the trend here. I think everybody sees that we have a long trend that's here in the market. You see the gray line, it shows an uptrend. That's a primary trend. Usually, I have to look it up. The primary trend, the long-term trend, it's about months, really a long trend. And the second one, that's a secondary trend. You see the blue arrow here. That's a correction. Usually it's a correction. And then a tertiary trend, that's the small one up there. That's another correction in the secondary trend. So before you start with the trading, you have to think about in what market situation you are at the moment. Are you in a primary trend? Are you in a secondary trend? Or are you in a tertiary trend? But how do we define a trend? And if it goes after the Dow theory, uptrend is a following of higher highs and higher lows, and a downtrend is lower highs and lower lows. So we need, for an upward trend, a sequence of higher highs and higher lows. And that's what we see here. You see the numbers 2, 4, and 6. These are higher highs. The market shows higher highs. And the numbers 3 and 5, that shows the higher lows. So that's a trend. That's a definition of a trend. It's quite easy. Like that, we can say it's like the stairs. If it points up, then it has an uptrend. The same counts for the downtrend. The sample applies to trend in falling markets. On that picture, they have sequence of lower lows. That's numbers 2, 4, and 6. And lower highs, these are the numbers 3, 5, and 7. So if I see a picture like that, then I have a downtrend, or to say it like that here, it looks actually quite simple. If the stairs point down, then we have a downtrend. What happens if the markets move sidewards? There we have horizontal highs and horizontal lows. And that's what we have a trendless market. So we can figure out actual trend in that. It's a side movement, and 30% of the time the markets move in that trading range. So I think everybody knows that we campaign in a trading range in sideward markets. Another thing is, in what angle does the trend move? That's something very interesting to know, to look at the angle of the market movement. If we have a strong trend, is it in a 45 degrees angle, or is it a 90? Yeah, 90 is too much, but is it a 60 degrees, 50 or 60 degrees angle, or is it even a 20 degrees angle? It's always nice to analyze markets like that, because if the angle the market moves very flat, then the market seems to be weak or suspect. If it's medium, like a 45 degrees angle, then we have a reliable market. And if it's two-step, then it's also difficult to say. It's we have to be careful with that market. The slope angle of the trend line can provide information on how we have to access the trend. And we take a look at that. A trend line is more significant or reliable as longer as it exists, the time horizon. It's more reliable the more often it has been tested, the number of support points in that trend line. And it's more reliable the more the gradient angle has an average of 45 degrees, or the typical movement we like to see. So in this special, something else, if we have a trend that's going to the upside, we have a long trend, then we always print in the trend line on the downside of the market. In this point, there's a trend line, and we see that it has been tested 3 times. And then we have a breakthrough to that trend line. And the market is coming back on the trend line, and the market is moving up and up again. But the angle of the trend line, it's 45 degrees, so we can say it's a healthy trend at this stage. The angle here, you can see it's 45 degrees or nearly. If the market breaks through that trend line, then we can see that the market is slowing down a little bit. And we can try to adjust the trend lines. A 2-step trend line can be drawn flatter if the trend slows down. That can we see in that picture. The trend is slowing down because the trend line is going flatter. A 2 flat trend line can be drawn stepper in the trend accelerates. So I just had a disconnection of my internet. A quick question: Can you still hear me? Yes, I see. It's yes, no problem. Thank you very much. So we can go on. So we said we have a trend line, and we take a look at the angle of the trend line. If the trend line is in the 45 degrees angle, we have a typical trend we're going to look at. If the trend is flattering, if the trend line is flattering, means less than 45 degrees, then the trend is slowing down. A good example of a speeding trend is this picture here. You can see the blue line and the trend. It's going really, really fast. You can see that on that picture. The angle is really more than 45 degrees, and this is a very speedy market. The problem is, what are we doing if the trend is broken or the trend line is broken? That is what we see in that picture. We have 1 point here, we have a 2nd point, we have 3rd point, and at the 3rd point, the market is breaking through that trend line. Then it comes up again, and you see the point up there where the market does not reach a higher high anymore. The market shows something, maybe it's a top. We don't know at that position, but we have to be careful if we see such a situation. Market has a good trend, a healthy trend in 45 angle, then the market is slowing down, coming back, and then break through the trend line again. The question is, how long does a trend goes, or how long is a trend veiled, and what are the criteria for breaking a trend line? And then we have a 3% rule. That means if you take a look at the literature, it's always called a 3% rule, that the closing prices must be at least 3% above the trend, above or below the trend line. Or with a 2-day rule, that means the closing price must be at least 2 trading days beyond the trend line. something very interesting if we trade stocks, then we can take a look at the volume increase, additional as confirmation for the trend break. So if we have a healthy trend and we have a breakthrough through a trend line and we have a higher volume at that point, then it could be a sign that there will be a trend break. Another good sign always is a gap. If we have a gap or if we have a breakthrough through the trend line with a gap, then it's often a good sign that the market could change and the trend is broken. Yeah. What else can we do? Channels. Channels are always a good thing to analyze the markets and to analyze the trends. For example, as a trend follower, I should note following. Do not get short at a return point in an upward channel. And do not walk long on the downtrend channel at return points. What does that mean? We take an actual look at the chart. We have a trend to the upside here, and we paint in the darker line, we paint in the trend line. And then we paint in a second line. That's a returning line. The low points are connected by the trend line, the dark blue line, and the high points by the return line. And what I just said, I don't want you to go short at the return point in the upward channel or in an upward market. That's always the thing people try to do, but especially if you're a beginner in trading, it's not a good thing. Wait until you have clear signs before you go short in a long market. Same happens for a short market on a downtrend. The high points connected the trend line, the low points connect the return line. Do not walk long in a downtrend channel at the return points. So if we have a return point here, often people try to go long at that position or at that point. And that's only a thing experienced traders should do. Trading beginners should wait until the trend is really broken. What I can use, if I'm not sure what will happen, I can combine trend lines. For example, I paint in 3 trend lines and make a fan of that. So that's a typical picture. More and more flattering trend lines. That's the fan principle. The break of the 3rd trend line signals a long-term trend reversal or could signal a long-term trend reversal. The first line, this one, the darker blue one, we have a very speedy market to the upside. Then the market is slowing down. That's the 2nd trend line we paint in. And the market's moving sideways. We can see that. And so we take the next high and we paint in another trend line. That's a green one. And we wait until the market breaks through that line. So broken upward trend lines become more often a resistance zone. Broken downtrends become a support zone. That's what we call structure in the market. Structure in the market. Whenever a horizontal resistance line is significantly broken upwards, the former resistance can become support. If you go long after break in resistance, the zone below the former resistance line is very well suited for stop loss protection. That is the phrase you always read in the trading books. And then whenever a horizontal support line is significantly broken downwards, the former support zone can become a resistance. If you go short after breaking in the support, the zone above the former support line is very well suited for stop loss hedge. That's the other definition you can often hear. Yeah, support is the price range which demand is stronger and exceeds selling pressure. All that confuses me when I begin with the trading, because everything I just told you applies to a long trade. But if I'm short in the markets, it's the other way around. So if you're in a short trade, like on a red side here, on a red picture here, what you see on a black line down there, it's not actually for your trade, for your short trade. It's not really a support. It's more a resistance than a support, because you want the market to break through that point. So I have moved to my own definition of support and resistance, and I just erased that. I do not use in my trading the word support and resistance anymore. I got over to calling it just simple structure. And structure is the point in the chart where the market was oscillating around a certain price level. Let's take a look at the chart to make clear what I just said. We find structure in the chart all over where the price has been at a certain level for a longer time. For example, here we see the market coming from the upside, tries to break through a certain price level. It didn't happen. The market come back and try again to break through. Now it happens. And then there was a retest of that structure level. Markets try to go deeper. It's not going to happen. Market tests this level again, and then tries to get through that level again, and this does not happen. So this price level around that black line or that dark blue line here in the market, it shows that this price level was important for the market. It was not easy for the market to break through that level on the downside as well as on the upside. So this is what I call a structure level in the market. And yeah, what's behind? What is the structure that is behind those structure levels, or how is structure created? That's that could be trend lines, also by trend lines in form of a diagonal line, or it could be former highs and former lows as a horizontal line. So always look left in a chart, what was happening there, or it was upper or lower limit of chart formations in the past, or it could be maybe a moving average, or it could be round numbers, for example, as a psychology number, for example, if it's a 50 or 100 or 1,000 or whatever, or it could be a multiple of what I just told you. Or it could even be a Fibonacci level as a price target, or as a very important Fibonacci level. The following example, or in the following example, we can determine a structure level by the horizontal line in the chart. You can see that that's the dark blue line. The price is oscillating around this level, so to speak. You see, it's here we try to break through. Here it's going happen that we break through, then we go up again. It's oscillating around that certain level. Once the price rebounds at this level, another time the price just breaks through it to the downside and then quickly remains it. That's what's going to happen here. Or we break through and then we try to get up anymore. That's what we see. The price has been in this area more often and has not easy to push through the upside or to the downside. And so that's a typical structure level in the market. Often structure or horizontal structure level coincident with the Fibonacci level. That's what I painted in here. As we see in this example, I think it's a 38% Fibonacci level, and the horizontal structure line coincide at the same level. If I go back one step, we see the blue line here, we see the Fibonacci level, and that's at the same basis. So sometimes it can be a combination of structure level, of prices, of round numbers, of significant Fibonacci levels. That's a structure level, and that should we pay attention to if we trade markets, especially if we trade swing markets. After all that theory I told you about the trends and the importance of the Dow theory, it's time to talk about entering in a new trend if you want to do swing trading. Once the main trend has been defined, for example, if it's a primary trend, if it's a secondary trend, or it's a tertiary trend, you have to find an entry. What I would recommend for beginners in trading, I would not follow a secondary trend or a tertiary trend for my first swing trading strategy. I always would try to look or would try to find a primary trend I can ride. But what happens if I define the trend I'm in at the moment? Yeah, it's patience that is required to get started. In this example, you already know that. We see that the market is moving from top to bottom. The market is coming from up here and it's going down. Then we have that certain price level the market wants to get through on the second movement, breaks through that level, and then it's going sidewards in that in that example here. The market consolidates, as we can say. Suddenly, then the market succeed in reclaiming the old terrain. It jumps up the blue line. Prices are rising again. Even we can see here a gap in the market. The market is once again overcoming the structure level and it's rising. We can see that here at that point. Here I put a red box around that. Now we must not jump into the market too early. That's what happened very, very often, that people see, okay, we have a gap here, They figure out there's a structure level, market is jumping over that structure level, and now they try to get into the market, and they just jump in without thinking. But I don't want you to do that. We don't have to jump into the market too early, because it could also be a false breakout here at that point, because we don't know what will happen next. Remember, we're on a day chart, on a daily chart. Each candle represents the price range of one day. The development of each candle takes a whole trading day, so you have enough time to think about what you're going to do. And that's one of the things I love about swing trading, that you have the time to do your research, to do your analysis, and to think about what you're going to do. And that's it, what makes trading those swing trades in larger time frames, like the 4-hour chart, like the hourly chart, so much more relaxing than trading the 5-minute charts or the 15-minute charts or even an hourly chart. You have enough time to think and enough time to do your trading decision and to do your research and your analysis. What going to happen? I just make this picture a little bit larger so we can see what happened there. You see the blue line, the dark blue line, that's the structure level, and the market is gapping up. Even in forex markets, this could happen, especially from Friday evening to Sunday evening. The markets could gap up and reach these new high levels here, but we have to wait. That's what we're going to do, because we don't know if this is not a false breakout. So we wait. We see the market is coming back again, and traders who can wait to enter the markets now jump into the markets early after the big white candle close. That's right here over. That's the big white candle, and traders who can wait would get into the market here with the close of this candle and the opening of the new candle. That's what I not recommend to you if you're newbie in trading, if you have to gain your experience in the markets, and if you try swing trading for the first time. So I wouldn't recommend to go into the markets with this white candle, because it still can be a false break out at that moment. The white candle, it shows that the market has strength to break away from the structure level, but that's not enough. That's not what I want to see. I would recommend a far safer method, and this is to wait for the new high. So left, I hope you can see my cursor here. We have a high on that side. With this wide big candle, the market shows a higher high. The old high, the low, and now we have the higher high. And that would be a much more safer method to get into the market. And that's the reason why we spend so much time on the Dow theory at the first part of this webinar. So market bouncing back, retesting this area, shows 1, 2, 3 white candle and shows a new high. And then one of the safer entries would be to get into the markets with the opening of the next candle. Think of the sequence of higher highs and higher lows. That is the determine of the trend. This is what the Dow theory tells us. An entry would be, as I told you, with the opening of the next candle after overcoming the old high. Now, the important question is where to put my stop level. And the stop level is below the last swing low, and that's the dotted red line. That's the reason why we call it a swing trade. We have a swing to the upside, we have a correction or a swing down, then we have a swing up, and our stop comes below the last swing. Sorry. After the market shows a new high, that's the dotted green line. Remember, we're entering the market at that point, market rising, short correction here at the side, and now we show a higher high at that point. And after the market shows that higher high, again, the dotted green line, I can follow the stop under the next swing low, and at this point it's the dotted red line, so I can put my stop from down there, and yeah, I can follow it under the last swing low. That's that point. So basically, depends on where I get into the market. My position is already on a good way. So the trade is almost in a safe area. Usually the risk is thus greatly reduced with this method to put the stop a little bit higher in a chart. Here, and at that slide we can see the sequence in which we would follow the stops. So down there it was our initial stop. Then after the market shows the new high here, we follow the stop to point 1, then we follow the stop to point 2. Market shows a new high, new low, higher high at that point, and we move the stop up to point 3. We orientate ourselves on the swings in the market. That's again, that's why we call it the swing trading. We use the swings to manage our trade. Once we get into the market, the only thing we can do is to manage our stop and to manage where we get out of the market. And that's how we can, or that's what we do by moving the stops. And yeah, one of the ways to get out of that trade is to pull the stop until the market is no longer showing higher highs. At that point, we will be stopped out at the next dip down. This is a good way to ride the trend until it is broken, because as we said, the trend is broken if the market shows a new low. At that point over here, we have a low here, we have a high, we even have a higher high. But if the market does not show higher highs anymore, but breaks through the line here, then we have a new low, and therefore the trend is not valid anymore. And this is one option we can have to get out of the market. So we ride the market, or we ride the trend as long as we can do. This is a good way to get all out of the market what we can do until the market or the trend is broken by definition. Of course, traders miss the top, but as I said before, the goal of this strategy is to cut out a good 2/3 of the movement for us, and not to get in and out at the low or at the high of the movement. That's very, very hard to do so. So this is a very easy and a very good method to ride the trend as long as it gets. Yeah, warning signals for the for the end of a trend. Deviation from the volume goes with the trend principle. That's what we know from the equities. Means that new highs are no longer under spin or underpinned by the volume. So if we have a new high showing on the market and there's no volume going with that new high, then it could be a sign that there is that the trend is going to end. That's one thing. If we trade the equities, we should look at the volume. Another way is I already showed you trend channels and a returning line. For example, if the returning line of the trend channel is no longer reached, it also could be a sign that the trend is going to end. And another very nice method I like is the divergence between share prices or financial market prices, like the forex prices. That's a very good thing to do there. With an indicator, for example, the MACD, or even you can use the trend reversal formations. So there are a lot of signs out there where you can find indications if a trend is going to end. So first of all, if we go with shares, it will be the volume. If we don't go by shares, I would use, for example, the trend channel and would look at the returning line of that channel. Reaches the market these returning line or not, or the divergence between the price and the indicator, for example, the MACD. And the point I want to show you is the simplest thing. That's the trend channel, and the thing with the returning line. Here in that picture, you can see it. I just want to visualize what I just told you. We have the trend line, that's a dark blue line. You already know that. And the market shows highs, higher, low, higher, high, and so on. And with the returning line printed in here in the market, and we can see we have a high here. Market goes back to the trend line. Market shows a new high and a second new high, but it does not reach the return line anymore. That does not mean that the trend is going to end now, but it's a sign that the trend could not be that healthy anymore. If the market no longer reaches the returning line and instead breaks through the trend line, this is a very, very significant warning signal. We should pay attention on that. And yeah, let's go back again in our example here. You can see that the returning line is no longer reached. When breaking through the downward trend line, we maybe consider to close our position, to close our trade. This could be also a second way to get out of the markets. And if you combine both methods, for example, the channel and the Dow theory, then you have 2 points you can look at, and you have 2 wonderful signals. There are many other ways to get out of the trade. Whatever method teach you or whatever method you prefer to use. There are a lot of indicators that can show you that the trend is going to end. Whatever you prefer, test it before you use it. Test them to see if there's a suitable for your type of trading. Personal, I already said, I really much like the divergence of the price and the MACD. In the standards, I just use the standard settings, and I really much like that. So if you like to test something, maybe you're gonna try that one. And there's one last thing I want to point out in this webinar. With swing trading, there are a few things you should pay particular attention to. So we need to look at risk management again. So getting into the markets is one thing. Managing the position, that also means to put a stop loss in the market, is the other thing. And I know a lot of traders don't do that. They don't use stops. But personally, especially in swing trading where market movements are much larger, they should really use stops. And therefore, I have an example how important it is to limit the risk and close the trade if necessary, especially in swing trading. I told you, uh, uh, you trade much bigger time frames. Yeah, and so it's very necessary. B quota means how much you have to earn again to get back on the original starting level. I call it the break even quota. So if you make a loss, for example, of 20%, and your starting account was £5,000, and you lose 20%, that's £1,000. Then you have to gain 25% to reach the level where you started with. So you have to gain 25% only to get break even. If you lost 40%, that's £2,000. Then you have to make nearly 70%. You have to make 67% to be break even, and then you don't earn any money. You're just at the point where you started. If you make a loss of 60%, of 80%, you have to make more than 100, 200, 400% to get break even again. So it's very, very important, in my opinion, to use a stop, especially in swing trading, because you're trading much higher time frames. And there are some rules. If you use swing trading, it's important to reduce the position size. The position size must correspond to your risk profile. So don't over leverage in swing trading, because I told you that the stop has to be placed under the last swing low, for example, in a long trade. And this could be a much higher amount of pips than you used to have if you only trade the 5-minute or the 15-minute or the 1-hour chart. So make sure that the position size fits to your risk profile. And it's important to make a stop at very each positioning that you're opening. The stop must also correspond to your risk profile. Use a stop that you that fits to your account size. Don't over leverage. That's the second point. And the leverage must be necessarily reduced, especially when the trader is a beginner. You shouldn't use a high leverage for those strategies, especially in uncertainty about the position. If you're undecided if you should take a trade or not, if you should open that position, and if you, on my opinion, if you're undecided, if you should take a position or not, I would not open the position. But you also should reduce the leverage. I already said, so if the stop is far away, and if you trade very volatile markets, in very volatile markets, you can reach levels very fast, and so sometimes it's not. You can't close the position manually, so it's important to have a stop and to adjust the leverage and the position size, and to make sure that the stop fits to your risk profile. Before we have to put a swing trade on the market, the exact position size must be calculated. That's a skill you need. You need to know how big your position size have to be. And the principle of the determination of the position size has to be understood. If you don't understand how to do that, please make sure you get that knowledge. An open position is always hedged with stop loss. It's the third time I think I say that, and the position of the stop loss depends on the candle situation and the trend determination. You know, you remember the higher high and a higher low, and we put the stop below the low, the higher low. That's it. And yeah, the stop is always traced. We always trace the stop with the trend or with the market, not against it. And the stop is pulled in soon as a new higher low for long trade or lower high for short trade forms. There's one thing, shadows. If you use a candlestick chart, the shadow and the wicks are taken into account during the stops. So we use that for calculating our stop. That's all I want to tell you today about swing trading. I hope you get some nice ideas. You can manage your trade. You can do a relaxing style of trading where you have to look at the charts only every 4 hours or every day. But before you do that, please make sure you understand the position size, the stop, and you may try to paper trade them first. So we are done with that webinar. I'm still here for questions. I want to say thank you for your attention, and until next time, thank you.